Is there a bond shock brewing? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Peter Boockvar, the CIO of One Point Wealth Partners and author of the Boock Report on Substack. Hey, Peter, it's great to have you back on.
Hey, Maggie. Thanks for having me back.
Unfortunately, a little bit of an ugly start to the week, or at least a rocky start. Let's say that it looked like they were in a holding pattern early in the day. We saw selling show up in the afternoon. Stocks were down across the board, crypto down, gold down. The VIX was up 16%. Some talk of one of the Fed governors with a rate hike, in favor of easing, maybe took a little bit of the sting out, or people just squaring up, maybe going into the close. But it definitely looks like investors are nervous. What did you make of the action today?
Well, I want to start by saying that come mid-November into December, dollars are precious in the sense that on the upside, no one wants to miss a rally at the end of the year. On the downside, no one wants to see their gains disappear at the end of the year. So every move gets exaggerated in the back half of November into Thanksgiving and certainly in December. So again, precious dollars for those that are trading and investing in these markets. Now, that said, I do think there's some fundamental changes that have taken place in the market. We know that the Gen AI tech trade has been the dominant force for the markets, and the underlying economic activity that it's all generating has, of course, been the dominant force for the economy. But there are two noteworthy stocks that I think is a reflection of investors asking tougher questions about this enormous amount of spend that has taken place. One was Oracle. We know that stock is more than $100 off its peak spike when they reported earnings. I think it was early last month, and people wondering, okay, wow, this is just extraordinary, the level of spend. And just to quantify, I went through all the numbers with all the big cap tech stocks, and just to define, Oracle's plan for their current fiscal year is to spend 52% of revenue on CapEx, not 52% of cash flow, 52% of revenue. It was 10% in 2021. The other name that I think was relevant in terms of the stock market's reaction to earnings was Meta. Meta had a phenomenal quarter top line. For them to grow revenue north of 20% on such a big base is hugely impressive. But investors put that to the side and instead focused on their CapEx numbers and praying that this was not going to be another metaverse. Meta is expected to spend about 35% of their revenue on CapEx. It was low teens pre-2022. So can this all work out for them? Yeah, maybe. We hope. But the numbers are just so large that investors are wondering whether it's going to be worth it. Also, I think what we're seeing is a wake-up call that these stocks were rewarded with very high valuations because of the asset-light business models, the dominant businesses that they were each in, and the huge amount of cash flow that they all generated. Well, now it's hugely capital intensive. They're all now competing against each other in terms of these models. And why should they get the same multiple that they did before? And that I think is the current sort of awakening that investors are going to realize, is that why am I still going to price these things at the same multiples when their businesses are changing? Then, of course, the poster boy for risk on, risk off over the past 10, 15 years has been Bitcoin. And it's hard to ignore the pullback that we've seen. Now, I have no opinion on why it's pulled back or what's going on. But if you're owning risky parts of the market and you're seeing what's happening in Bitcoin, there has to be an antenna that goes up.
Yeah, it certainly seems like that. So we have Nvidia coming out this week, and there have been some concerns before, and then we see companies come out and they crush it on revenue and they're super optimistic about the future, and then everybody seems to sort of get back on board, like, okay, this is real, like they're real revenues, this is not .com. It feels like sentiment's changed. How are you thinking about what's going to happen? I mean, can they turn it around, or is it just impossible at this point to meet those high expectations?
Well, nearing a $5 trillion valuation, the bar is extraordinarily high. I'm sure Nvidia is going to report a great quarter. We'll see how the guidance is. I think what's also important with Nvidia, because there's this big debate with these hyperscalers in terms of how quickly or how not as quickly they're depreciating a lot of this expense. What is the life cycle of a GPU nowadays? What is the life cycle of a data center? Because if you elongate your depreciation expense, you help earnings. If you shrink it, you hurt earnings. And I want to hear what Nvidia has to say about what their life cycle is, because we know they keep coming up with new generations of chips. And how quickly does that make the prior chip more potentially obsolete? What's the pricing of some of the older chips? Are they hanging in there in the sense that, yes, they're slower, but still maintaining a certain level of pricing power? Or is the pricing degrading because the newer chips are so much better than the older ones? Because that filters through to the hyperscaler assumptions on depreciation. And then, of course, the sustainability of all this. Overall, one of the issues that I have with the spend in terms of the number of data centers and the extraordinary size of these data centers, and the defined size, Meta's facility in Louisiana that they're building, that's going to cost almost $30 billion, that they created a special purpose vehicle to finance it. It's going to be 4 million square feet. That's about 60 plus football fields. And maybe they'll need all that space to house all the servers and GPUs and so forth. But what happens if in a couple of years, the computing power is even greater, but maybe they need only 2 million square feet? Because the history of technology is the hardware gets smaller as the software and the chips get more powerful. And so that's why I and we would never invest in the actual physical structure of a data center, because I just don't know what data center is too much and what the actual size of the physical presence we're going to need, because technology just accelerates and obsolescence, creates obsolescence so quickly. Now, that said, I do think that at some point, maybe now or in 2 months or 2 years, people are going to start to look at the beneficiaries of all this spend, and that's going to be the users of AI or this form of AI in terms of how they integrate it into their businesses and households and so forth. And because at the end of the day, all these big companies are just creating commodity product, and some, like the Chinese, are giving it away for free, and they're producing a pretty high quality product that's going to be major competition for the U.S. companies that are building these models.
Yeah. So you brought up a great point before about it going from a capital light to a capital intensive business that they're in, or period that they're in, as you just mentioned, even with things with data centers. But you also, I think, are kind of pointing out that there's no obvious moat around any of this, right? There's no pricing power that they have or that we can identify right now based on all this spend, is there?
I mean, there doesn't seem to be, particularly with the open source competing with the subscription model, and they're all trying to create something that'll be very similar, something that is on demand and that you can use as an enhanced version of Google, or you need to consolidate your notes, or you need to have something write your emails, or come out with forecasts, or create new animation, whatever it is. They're all trying to do the same thing. So yeah, the moat is not there like their existing business was, and it could be great for us. It'll be great for the users, but the builders, God, it's costing a lot of money to create that.
Yeah. It's going to be interesting to see. Nothing ever looks the same, but that we don't know who's going to figure out how to optimize that. But you're right, it's going to be on either a user end or maybe a company that doesn't exist. Does it mean that these tech giants themselves won't be able to harness it? I think that's their sell, isn't it? That there's no moat now, but we will be the ones with all of our expertise and brain power and engineering and AI geniuses that figure out what to do with this to create a business model. I suppose that's possible, right?
Yeah, I mean, just look at Cisco. Cisco stock last week got within $1 of its closing high of about $80 in March 2000. It took 25 years. 25 years ago, you could not build the backbone of the internet without Cisco routers and
Remember.
networking equipment.
Yeah.
And here we are 25 years later in nominal terms, just getting back to where you were. But look what the internet created. It's been extraordinary. So the beneficiaries again of Gen AI going forward from here are going to be the users of it rather than the data center infrastructure builders of it, I believe.
Yeah. And let's also remember that some Cisco survived. Not everyone did, right? It took them that long to get back, but there are a host of companies that were critical in the build out of the internet that didn't make it. And great flag on the
Maggie, you froze.
depreciation.
You froze up the last 15, 20 seconds. Sorry.
You okay? You got me back?
Yeah. Yep.
I was just saying great flag on the depreciation aspect of it. That is what you do best, is get down in the weeds on this stuff. And it's sort of probably something people haven't really thought about, but it's going to be really critical in those reports for the rest of, as you said, the sort of the supply chain and the chain of events on that. So fantastic stuff. And I know you'll be writing about it on your Substacks. We have a question for a couple different questions, but let's just wrap with tech. Because people are concerned a lot, and there are quite a few risks out there. If we see disappointment on the back of Nvidia and tech corrects, or we see further weakness in tech, does it take down the whole market, or could we see rotation to some sort of lesser loved areas?
Well, ideally, I would love to see rotation, just as we saw rotation in 2000 and 2001, before everything fell apart in 2002. And my money is where my mouth is, because we own a bunch of we own some of the big names just in some of the indexes we own, but I own in my portfolio a bunch of things that aren't related to that. So I hope there's rotation. My worry, though, is it seems that the U.S. economy and the U.S. stock market is all in on this AI build out and trade, all in, literally all in the sense that the first half of 2015, without the data center build out, GDP growth was flattish. Without this Gen AI tech trade, where would the stock market be? It would be a lot lower than it is today. So that's my worry, is that if we lose that, then we're going to lose a lot of other parts of the economy, even though ideally I would love it if the baton can be passed on to something else.
Yeah. Rafa's asking about any thoughts on financials. Very specific question. And I don't know if you've seen this, but I'll ask it, Rafa. But if not, let's just talk about financials more broadly. He's asking, do you have any thoughts on the reversal in financials that came out at noon when the I don't know if he means SEC, he's saying SCE, but I think he meant SEC credit report came out. Did you see that came out, or were you watching financials at all today?
I didn't see that specifically, but I've certainly been watching the delinquency numbers. I've certainly been watching rumblings in private credit, the bank funding issues and factoring with First Brands and Tricolor, and I'm watching all of that. And these stocks have had tremendous runs, helped out by steepening the yield curve. But I do think that there are potential balance sheet issues that the financials face, and considering the run that these have had, if there's any slowdown in capital market activity with this downturn, these are the stocks you don't want to own. Morgan Stanley benefiting from wealth management and capital markets activity, Goldman Sachs. Well, if the markets can have a hiccup, those are the stocks you want to sell. So I would tie it to that. But and to sort of widen the lens out further, I mean, the business development company stocks have gotten hit. Story in the FT that Blue Owl is taking one of their private funds, merging it into their publicly traded BDC. And because the publicly traded BDC is trading at a 20% discount to NAV, that fund that's getting rotated in is going to take a 20% haircut, which I think is a wake-up call to everybody that is in private investments, private equity, private credit, thinking that they're lower volatility investments, and that because they don't trade as much, you're not really losing money. Well, here's a wake-up call that, trust me, the value of your holdings are changing every single day. And just because you're not marking it to market every single day doesn't mean that the value is not going up or down. And investors in that Blue Owl private fund
Mm.
is realizing that with a 10% a 20% haircut if the shareholders vote this deal.
That's a really important point, because I feel like, so that's the warning to the people who invest in private credit, that you
And
are
equity
vulnerable
too.
to that.
Yeah.
What about the flip side in terms of counterparty risk, or just sort of more broadly systemic risk? I think there was a feeling that, if there's frothiness or speculation or malinvestment or misallocation of capital, that, well, it's in the private part. More sophisticated investors know what they're doing. It's not sort of on the balance sheet of the big banks, or in the way it was before. Should we be wondering about that assumption? Is there really a firewall between that?
Well, I'm not worried about systemic, but I do believe that if the economy rolls over, I'm pretty confident that when so much private credit money chases not enough good deals,
Mm.
that you'll find plenty of instances of bad underwriting. Now, where that is going to sit, whether it's at the private equity / credit asset manager, or the banks are going to get impacted because of the non-bank loans they're making to those entities. I'm less worried about the banks. Going through a bunch of calls, a lot of the regional banks in particular, because the money centers are just fine. I'm not worried about them, even though they'll have exposure. But a lot of these regional banks, I think they were smart with their lending to non-bank financial institutions. And from what I saw, none of those loans really made up more than 3 to 5% of loans. I think maybe at the peak there was one bank that was maybe closer to 10, but nothing that I believe is going to threaten the viability. But you're going to have bad loans, and if the more bad loans you have, the more scrutinizing investors will be going forward, which means that there's be less credit flow. We also know that this is in the context of credit spreads that are extraordinarily tight, that will likely widen out just from a risk aversion / risk management perspective on the part of investors, and that could change the financing landscape. And what this also does is it sort of neuters Fed rate cuts in a way. The hope was that Fed rate cuts is going to provide relief for SOFR plus borrowers as SOFR falls. But if the plus part rises as an offset because lenders rethink the pricing at which they're lending out money, well, then we're not going to get any benefit from lower Fed funds rate. Also, what we've seen is long rates aren't going down. The Fed has cut 150 basis points, the short end, and the 10-year yield is really no different than it was in the summer of 2024, right before they started cutting rates. Look at European yields. The German Bund yield, the 10-year yield, is above where it was before the ECB cut 200 basis points. The same can be said with gilt yields, and we're seeing another leg higher in the 10-year JGB yield. So I guess my point with all that is that don't think that Fed rate cuts are just going to save us like they have in the past. There's other stuff going on that I think is sort of diluting and / neutering Fed rate cuts.
Yeah, that's a great point. And Akash asking about that. He's sitting in the UK? Does Peter have a view on the U.S. fiscal situation? Does the U.S. deficit have to get worse from here before it gets better? I'm from the UK, and nobody in the UK government wants to tackle our fiscal mess. And if I'm not mistaken, there's a budget. There's something coming up the day before Thanksgiving, and they're faced with some really difficult choices. But it's sort of everywhere, to your point, Peter. Are bond investors starting to push back and revolt a bit on sovereign bonds, on the sovereign bond market? Is there a trouble brewing? Because that used to be the safe haven.
Yeah, debts and deficits now matter. The increase in the 10-year JGB yield to start in Japan, which rose overnight to a 17-year high, is in response to concerns about a fiscal stimulus package out of the new Prime Minister's administration. The UK, they cannot make the tough spending decisions that they have to make. Instead, they keep trying to raise taxes, but then that slows growth, and that makes the budget situation even worse. They're going to reach a point where they're going to have no choice but to make tough spending decisions, because you're not going to tax your way out of this. The U.S. is interesting because we have still very wide budget deficit relative to GDP, and of course, an ever increasing level of debt. But the pace of increase relative to GDP in the U.S. has shrunk a touch, and that is because the pace of spending has slowed a bit, and we have taken in some tariff revenue, even though I don't like to rely on that tariff revenue because I don't think it's really that much in the context of $7 trillion of spending. But the trajectory of U.S. budget deficits relative to GDP has begun to come in a touch. So a slight positive, even though obviously the absolute numbers are still very high in terms of spending relative to revenue.
But I mean, first of all, you put everything together and there's this AI sort of, enthusiasm that's starting to fade and confidence looks like it's breaking a bit there. You have sovereign bond markets that are under pressure from bond investors who are saying, hang on a second, and pushing yields up regardless of what central banks are doing. And you have these pockets of liquidity issues. We just had Michael Howell on, who's watching the repo market really closely, and you're seeing strains. All of that together sounds very worrying, Peter.
Well, the strains in the U.S. in terms of repo rates, overnight lending rates, and so on, it's something we're watching. I mean, the Fed set up their standing repo facility to try to mitigate any of those pressures. It's obviously coinciding with the Fed no longer shrinking its balance sheet, but also there's year-end financing pressure as well that we're watching. But all these coming together, it's something to watch. I mean, we know that the Fed's overnight repo facility has really been drained down to zero. Treasury General account has obviously increased. There's a flood of T-bills that the government's trying to throw at us. That's that's adding a lot of supply to the market. So I think a bunch of things are coming together, and it's something we're all watching. How it plays out, I'm not sure, but just because so much of this is new. I mean, this standing repo facility never really was used to the extent that it is right now. Can it be ramped up enough that it'll ease things? I'm not sure. A lot of this is just so experimental, what's going on. Yeah.
Every time we think we're getting back to something traditional, all those calls for the Fed to unwind its balance sheet and everything, there is these big problems keep forcing their way in and forcing experimental policy responses for a problem seems like we can't solve. JM asking, what'll be the case for household food stocks? Are they in a secular bear market?
So that's interesting because we've gotten long some of them because they've just been so destroyed and beaten up. And we're long Nestlé, Kraft, Conagra, Pepsi, Coke, to name a few. Actually, those are really the ones. And the secular downshift in take Kraft, for example, has been clear. But what's interesting with those stocks is, well, at least with Kraft and Nestle, since they're more globally present as opposed to Conagra, which is more U.S. focused, is that these businesses are actually doing pretty well outside the U.S. I think in the U.S., a lot of their pressures have been pricing, which has hurt volume after the last 4 to 5 years of inflationary pressures and a lot of sensitivity in terms of elasticities with that lower income consumer, which is cutting back on snacking. Like Papa John's, for example, to this point in their last quarterly earnings call a couple weeks ago, they said that, interestingly enough, their pizza business is doing fine, but it's the add-ons that's doing less fine. So instead of ordering a pie and getting a side of wings and getting some garlic bread or these Papa Bites, for example, people are just buying the pie and they're buying less of the side stuff. So when it comes to snacking for some of the food companies, snacking being sort of a discretionary item outside of your 3 meals during the day, there's less demand for that. But I do think that these companies are doing a lot of self-help. I think that they're trying to improve the quality of their product. They're trying to take out a lot of the processed stuff. They're trying to improve the taste. They're trying to really improve the product lines of their business that I think will eventually show up in their sales, particularly if low income spending remains muted because these at the end of the day are still low cost products. With Nestle, for example, half their business is coffee and pet food. Well, now that we've seen some drop in cocoa prices, they are subject to that too with the chocolate business. But also coffee prices are coming off as we're taking off tariffs on imported coffee. So I do think that this is a place to hide. They're paying great dividends. So you're almost buying bonds with equity-like upside in some of these things. But I grant that, the charts are some of the ugliest ones in the markets.
It's funny you say that. First of all, J&J pointing out that a lot of Peter's buys pay really good dividends backed by cash flow too, especially CAG, CAG, and Nestle. This is because Peter does the deep dive work and looks for that, right, Peter? I mean, that's what I always know you to be digging around for and prioritizing. And speaking of trading like bonds, we have a couple of specific questions, your thoughts on that, but I want to flag something that Ched asked about. What does Pete feel that if bond markets croak, I love that, let's hope they don't, croak in 26, 27, or in the future, that these Mag 7 companies will be preferred as bond proxies if the debasement era intensifies? It's an interesting question because I just recently had someone talking to me about a big tech company with a pretty big balance sheet, like, oh, well, it's sort of like a bond, especially if there's concern about sovereign bonds. And you just kind of made the same point about the kind of consumer staples. Are you hearing a lot of that? Are people thinking, like, sort of starting to look at companies through that lens, I guess?
Well, interestingly, right now, people are looking at the Mag 7 balance sheets not as a safe haven. They're becoming more worried about them because of the debt that they're accumulating to build this data center construction.
What about Apple though? Is Apple doing that?
Yeah, but all the cash levels, the net, Apple's not really, but the amount of stock that Apple's bought back over the years has shrunk their net debt to a much smaller amount. I mean, Apple is north of $100 billion of debt. Granted, they have a lot of cash, but that net debt has shrunk a lot. Now, I understand the point of the question in that if you look at the broader market, these companies, Meta and Microsoft and Apple and Amazon and Google, they have healthier balance sheets. So maybe they'd be ports in the storm, I guess, could be sort of what the question is. My only issue with that is maybe from a balance sheet perspective, but not from an income statement perspective, because if all their customers have a difficult time, well, then they're going to have a difficult time too. And at the end of the day, we're buying phones from Apple. Companies are advertising on Meta and Google. Companies, if they hire less or fire people because the economy downturns, well, they're going to be buying less Office 365 licenses from Microsoft. So you can't just buy those stocks and say, hey, they're great, their balance sheets are fine relative to everybody else. You have to look to see how their customers are doing. Because I heard the same argument in 2000. It was like, okay, well, the Fed is now raising interest rates in 2000. So you got to own Intel and Cisco and Sun Microsystems because their balance sheets are the best. Meanwhile, all their customers were going out of business.
Yeah, fair point. Ian asking if you're still in Tesco.
Yes, we still long Tesco from a valuation and dividend play. Tesco has done a phenomenal job. For those who don't know Tesco, it's the largest UK supermarket chain in the country. And they've done a phenomenal job of competing against sort of the discounters, the Aldis of the world, the Sainsbury's. And I think, yeah, we're still long, and I still like the way the business is being run.
I always liked going in at Tesco when I lived in London. And then Peter asking if you still like Under Armour.
So Under Armour has just been a disaster of a stock. It's probably the ugliest chart out there. You can ski down that mountain, but I still really like what Kevin Plank is doing. They are really focusing the product line on certain target markets. And by lowering the SKU count, they're trying to raise the price points. They're also being much more careful about where they're selling, what platforms, and certainly where the retailers. They don't want you to be able to go into a Kohl's and see a gazillion discounted Under Armour shirts. So I really like what he's doing, and I like the new product innovation. And I think this is a great turnaround with a stock that is just so cheap. I mean, you're talking about a $5 billion sales company, which has been pretty consistent if you take into account the forced reduction because of the SKU count cuts. I think their brand has still a lot of relevance, and the market cap is $2 billion. You can buy it a fraction of sales, 40% of sales, and balance sheet's still good. Net debt is pretty low, so I think they can manage through. But they're also dealing in a tough macro. They're dealing in an environment where consumer spending is much more circumspect. And that macro challenge is obviously something they can't control. But I do think internally, everything that they can control, they're doing a great job. And with respect to the stock, over the past 2 months, 3 directors have each bought $500,000 worth of stock, each buying about 100,000 shares. So when I see insider buying, I get excited. And when I see 3 insiders buy, I get even more excited that at least people inside and on the board in this example, if they believe it, based on my work, I'm going to believe it too.
Super interesting. If they manage to do that, it's going to be a really great management case study too. Because, Kevin Plank, for those who know the backstory, super entrepreneurial, grew that business with a very specific vision and niche, right? It was sports. It was the sort of undergarments, having been a player himself. So it's really, and they got super broad, and it'll be really interesting if he can refocus and rejuvenate that stock. We're almost out of time, but I just want to acknowledge Jeff on Substack also talking about risk of contagion in the private credit market. I don't know if you came in late, Jeff, but we did talk about that specifically. Peter was talking about Blue Owl forcing their private fund investors. So just reboot and check out that part of the conversation, because you're spot on. And it's something that Peter's been writing about and talking about as well. So super great stuff. Peter, love catching up with you. I say it every single time you're on, but I'm going to continue to say you do really, really detailed work.
Thanks,
and
Maggie.
it certainly puts stuff on my radar that when we're all busy, sometimes we miss, and you're super thorough. I don't know how you do it, but super appreciated getting it in my inbox every day. So we always put a link to Peter's work below if you're interested in checking it out as well. And just a heads up before we go, our latest episode of Major Notes is out on Substack. I had the chance to sit down with Chris Perkins. If you don't know him, he's the president and managing partner of Coin Fund. Amazing guy. Talked about a journey that took him from the front lines of Iraq to the top of Wall Street. Here's a quick little peek.
That was like a super pivotal moment when, you're from, Podunk, New Jersey, and then you show up and you're in Moscow, just as everything is changing. But the great thing about the military is that everything is designed as you become an officer, especially the Marine Corps. That phase of my life, everything was designed to teach leadership. I remember years later in finance, it's like, oh my gosh, I'm going to manage people. This is so hard. Next thing I know, I'm there in Ramadi. I'm landed in Iraq, and I remember I saw Oliver North on the way in. He's like, be careful. They're like, what do we do with you? Like, what do you do? And I was like, well, I was an artilleryman by trade, so I make a lot of calculations and I manage risk. But if my risk is wrong, people die. What about you? I mean, I remember watching all my trades just start going away. And because as each of our counterparties would terminate our relationships, the derivatives would go insolvent essentially. And it was horrifying.
I mean, he's on the front line of many, many episodes in history. Super interesting conversation. So be sure to check it out and subscribe to us on Substack if you're not already. And you can find Peter there as well. Peter, thank you so much. Such a joy. We'll see you again soon, I hope.
Thanks, Maggie. Always fun.
Thanks, everybody, for the great questions. We'll be back Wednesday. In the meantime, take care and good luck out there.